What's going on? Thank you so much for coming back to the channel. Today we're talking about GameStop. Look at that beautiful hill coming up over the valley. Now we do want to make a quick note here, a little bit of technical analysis. We see that GameStop had a major rise, about 10%, when our hero, our savior, Roaring Kitty, started talking at roughly yesterday. Now at the point of the rise was the greatest when he actually took the stage. It rose up all the way to like 47, 48 bucks, and then it did the same sundial Tilray magic hump all the way back down, and it actually continued to tumble throughout the hearing until it reached all the way down to 40.69. At this point, when market closed, it was mainly oversold. We see in the RSI here that it was dipped underneath 30. Now, as we are reaching the promised land, we are seeing the RSI start to dip above 70, which means that it is starting to become overbought, although that is not much of an issue for us. We are seeing some green candles around the board, and that is exactly what we're looking for. If this is the first time that we have not yet been acquainted, I do want to say we do a lot of research here on the channel. I do appreciate you guys hitting that subscribe button, making sure that you smash that like button, turn it blue. And now I want to talk to you about what is going to happen with GameStop and how to plan it forward. This is an extension of this Redditor's DD series on GameStop. I have been investing, learning about, and following GameStop since September 2020, and in that time, this person's learned a lot of things. It is also likely their last post on GameStop for a while, as they find themselves repeating key points, and others are doing an excellent DD on GameStop in the meantime. In this post, they'll try to share as much understanding as they can about how we got there, about shorts, and about their thoughts on the future of GME. They also try to include many tips around trading and investing with GME going forward. Too long didn't read. The squeeze has been reset. Shorts have reset their short positions at much higher selling points, and longs have been likely cycled through. I don't believe a Volkswagen squeeze is possible because Robinhood will just get choked again, but I do believe GameStop is worth much more than $50 a share. Forget diamond handing. They're going to start accumulate shares again. I share below how they're trading with GameStop. This is a good point to say that none of these opinions are meant to be financial advice. I am not a financial advisor. This is just one Redditor's due diligence on exactly how they would approach GameStop moving forward. So as of right now, I have to say I do have a stake in GameStop, and I am not going to be swayed by this Redditor's opinion. I just want to fully share what this person has done in terms of their research. So previous important posts here are in-game part 1, part 2, part 3, part 4, and part 5. Here are a quick summary of exactly what happened before. DTC Infinity covered the short positions, the float, and potential snowball impacts of increasing prices, and argued that the part of the reason that shorts haven't closed was that it was pretty much impossible for shorts to close. Part 2 covered Cohen, fair market cap analysis, and potential investors, in which they talked about the amazing mid to long-term potential for GameStop. After the Citron tweet, they shared a fan fiction on what the blatant market manipulation by shorts on the day of the tweet, and they offered some education on strengthening your position. This one got buried, but it is worth reading. Endgame part 3 covered the gamma squeeze, shady tactics by MMs, and some tips on staying safe. And then part 4 covered the continued gamma squeezing and the resulting tenuous position of the 50 million shorts that were still in GME. And then 5, deleted by mods, but someone else posted in the comments, went into implications of the absolute mind effery trick the shorts pulled when they limited buying of GME and other heavily shorted stocks. If you guys did want to talk to me live, this is why we are on a live stream and exactly why we're talking about GameStop here. Important external reading. These 3 non-Reddit articles are critical for understanding the short playbook. This is essential reading if you want to understand how the funds that are short GME have been manipulated, directed by the DTCC to strong-arm Robinhood to halt buying on the 28th. The takeaway is that all of the core investigation needs to be happening with the DTCC and SEC to understand why the margin changes were forced upon Robinhood and who specifically asked for the buying halt on the 28th. They believe that shorts worked together with brokerages and the DTCC to rob investors of over $40 billion of value, and representing what is probably one of the greatest financial crimes of the century. So this is what the anatomy of a short attack looks like. Seeking Alpha article from 2014, flooding the offer side of the board, leveraging counterfeit shares, media assault. These are all different tactics that I mentioned in my what can the institutions do to drive down the price of the stock. If you guys are interested in that, I'll try to link it either up here or down below. analyst reports, and then frivolous SEC investigations meant to distract the SEC. Very much like this one against Roaring Kitty. And so that is exact. And then finally, pulling margin from long customers. These are really important points. Illegal naked shorting is DTCC. Continuous net settlement and stock borrowing programs have loopholes that facilitate illegal naked shorting. Remember, this is a big naughty play. And we have a couple of bullet points here. There is an integral relationship between the DTCC and hedge funds on regulation SHO. However, Wall Street has a bag of tricks to get around this requirement. One of which is simply to ignore it. Another is to roll the position of another broker-dealer. Oftentimes fails to deliver can last for months or years. The SEC seems strangely unwilling or unable to enforce this provision of regulation SHO. And then finally, my favorite topic, phantom shares threaten U.S. companies and investors. This article is a bombshell. A former DTCC employee whistleblowing fraud in relationships with DTCC and short funds. I've explained this a lot of times before. It's essentially is if you had a bad rating on Yelp because you put too many rats on your pizza for a pizzeria, and now you just decide to deliver pizza to yourself over and over again, giving yourself a 5-star rating each time. This inflates both the numerator and the denominator for your rating, and it makes it seem like your company doesn't serve rat pizzas, in which case a counterpoint, it definitely does serve rat pizzas. I'm trying to be the John Oliver of finance, if you guys haven't noticed with these weird analogies. What's happening with GME happened before with Fannie Mae and Freddie Mac, evidence that more shares were sold than ever existed. The main problem is that Reg SHO has no real teeth for enforcement. The brokers are never called to be responsible for their behavior. This is documentation of phantom shares and synthetic longs have been called out by the SEC since 2013. They just have known this. Like, what is the point of like finger wagging and conjecture and calling people conspiracy theorists if this is actually documentation that they've known for a long time? Banks play by different rules. The SEC continued to declare that fails to deliver were not an indication of naked short selling. That changed when Goldman Sachs and other financial firms needed to be protected. Trimbath pointed out that not till the bank's broker-dealers began to see massive numbers of fails to deliver in their own shares did the SEC put a short selling ban in place, but only for the shares of banks, insurance companies, and securities firms, including the very culprits responsible for the dirty system. Naughty, naughty, as a la the representative from yesterday and Borat, who controls the DTCC. The answer is that banks and brokers who use DTCC services, who process trades there, who fail to deliver there, are insiders who sit on the DTCC board of directors. Seems like the question of who watches the Watchmen has been woefully answered in this question. History of shares and shorts on Gme. I see you guys on the live chat. Keep the live chat going. This is just going to have to be a clip that I'm going to cut up later. Here's some history on Gme that's worth knowing so you understand the context of where we are today. Gme used to have many, many more shares outstanding. Point in question. Back in 2009, there were over 160 million shares outstanding, and GME has steadily been reducing the number of shares outstanding through buybacks and share retirements, concluding with a massive share 40% buyback in 2019, pushing GME under 70 million outstanding shares. When you look at a price history chart, you need to factor this in. When GME's share price was $50 in 2008, its market cap was actually $8 billion, not $4 billion like it is today at $50 a share. GME used to be in the S&P 500. We used to forget. It was added in December 2007 when it had around an $8 billion market cap and removed in April 2016. It had a nice long 9-year run when its market cap had dropped to $3 billion. In 2016, there were about 25 million plus shares shorted of GME. It's very likely GME was shorted out of the S&P. Short interest did not decrease after share buybacks. In 2019, GME bought back and retired 40% of their shares, yet amazingly, the short interest increased. How is it possible that shorted shares, if not naked, did not have to find new borrows to cover? How could they have found $30 million borrows in such a short period? So, how were the shorts able to increase their short position by 20 million shares in such a short period of time? No pun intended. In July 2019, GME bought back and retired 10 million shares. At the same time, shorts increased their short positions by 20 million shares. How is this possible? How could they have borrowed 20 million more shares while shares are being retired and removed from float? Well, here it comes. Shorts did not close at $3 because of a tax loophole. Shorts had been shorting GME since well over $40 a share in 2015. By April 2020, GME had dropped to under $3 and shorts were sitting on billions in profits. So why not take the profits? A little known tax loophole allows hedge funds to pay no taxes if a company they shorted goes bankrupt, as they not need to close the trade, so the profit is not realized. This is mind-blowing. Taxation on companies is exactly how everything stays regulated, right? And that's where the Democrats are trying to push their bill of transaction-based taxes, so that at the very least, when the hedge funds and the large players try to pull something like this, then they can't. But this also hurts the individual seller and the retail investor as well. However, this is something that is very annoying, right? They don't pay any taxes if they short a company to bankruptcy. They are incentivized heavily to do exactly that. So that's where all of our troubles came from the first place. Many of the major short funds are disciples of Steve Cohen, who previously paid billions to settle insider trading charges. Mapleine Capital, Melvin, others are all Steve Cohen cronies. Who bailed out Melvin? Steve Cohen. There are many strange connections between DTCC's actions and shorts. As you know, DTCC and SEC put a gun to Robinhood's head, demanding billions in liquidity to support their customers buying GME. At that point, more than 50% of Robinhood users had GME. Now, it's important to note that Vlad is not really doing himself any favors by making himself seem so bad at answering yes or no questions, but it is the big point, right? We're looking at a crony, Vlad, the skinny Adam Driver, the evil Keanu Reeves. He is essentially did have a gun pointed to him at the time and say, hey, don't buy any more GME, right? And since he folded, he does have a part of the culpability in this sense. Robinhood is only worth about $10 billion. The amount asked for from the DTCC was likely to drive Robinhood into the ground if they had not found a solution. And their solution was, I guess, just cave. Key question, who suggested the buying halt? Was it Vlad? Or did the DTCC suggest a buying halt as a negotiation tactic to reduce the liquidity requirements? Sounds very much like a turn off buying or else kind of arrangement. Keep in mind that at this point, shorts were at the verge of losing upwards of $50 billion as GME was well on its way over $500 a share. So Citadel didn't care about shooting down Robinhood. It's a minor toe amputation to save their leg. Citadel having to answer for a lot of these questions really ended up being a bigger bad in the sense of having two people in a room and one person clearly reading off of a teleprompter very slowly with 5 other people helping him in that room. The 4 a.m. call with the DTCC happened 2 days after Citadel and .72 bailed out Melvin, and 1 day after the put-call ratio for GME flipped 3-to-1 for puts. Not only was this coordinated, shorts knew this was coming and profited from it. If a regulator, lawmaker, SEC agent could figure out who bought those puts, you'd know something interesting. So we're going to keep that going because this story gets deeper from here. So we have to understand why GME went up. Many pundits in the media were extremely confused why the price of GME got so high, so let this redditor try to explain. First, the current price of an equity is just the last traded price. This is a very, very critical piece you need to understand. When there are 70 million shares outstanding and 1 million shares get traded back and forth multiple times a day, the price you see is just the price of the active float trading back and forth. This is why many technical traders pay very close attention to volume. Now, when there's high trading volume relative to total float, it's easier to believe the price is more reflective of actual underlying value. In the case of GME, supply and demand is the critical driver of price. As they mentioned in Endgame Part 1, the true supply of GME shares, tradable float, is ridiculously low. The demand side comes in 4 parts. 1, value buyers, right? People who like DFV, who saw a company at $4 valued less than 1 year cash flow and decided to tell the world about how great of an opportunity this was back when you could buy it back at that low of a price. Squeeze buyers, people and funds that smell blood in the water and bought shares in anticipation of someone needing to pay more. And that's what a lot of the theory, the data science, like actual econometrics that we talked about on this channel, some of you might be squeeze buyers waiting for that squeeze. Shorts covering shorts that needed to or wanted to buy as the trade went against them, and then hedging. Repeated gamma squeezes that had outsized impact on price due to the low underlying liquidity of GME. For normal equity, most of the demand side does not exist. Low supply plus high demand equals high price, right? This is as simple as economics gets. That's why GME shot up. If I'm the one selling a YouTube course and it's selling like hotcakes, right? A high demand, low supply. There you go. Perfect time to raise the price. A big reset. This wasn't just a squeeze. This was a massive reset on investors long and short for GME. Any SEC filings, 13G or 13F, shows positions prior to February 1 are irrelevant other than insider positions. It's very likely many longs liquidated during the squeeze and likely many shorts covered. Some of those longs that liquidated may reinvest, but some of the shorts that covered may re-short. So shorts that were given a huge bailout, whereas they previously were sitting on losses upwards of $50 billion, they were instead able to close positions at much lower share prices, with GME currently sitting at $49 a share, a 90% reduction from its peak of $500 a share prior to the buying halt on the 28th. This is not the end of GME. Everything started with a value on GME. At $50, we're coming back to a value play. GME's market cap is now under $4 billion. Remember that GME has over $1 billion in e-commerce revenue alone every year, and e-commerce is growing at 300%. For more on market cap potential, go see Endgame Part 2 or the excellent GMEDD.com. Nothing that happened in the last few weeks had changed the core fundamentals of the business or the prospects for a Cohen-led revitalization. So if you were in this for Cohen at $20 to $35, we're not too far off from that right now. If people can afford to hold their shares, the float continues to shrink. Wild cards remain. In order to of decreasing the likelihoods, this is going to be the most likely. Cohen still needs to buy his 7%. He's likely waiting for a good signal from the board that he's going to be CEO, as well as a good entry point. The officers added to the company on the board also need to buy their shares. They are not buying in at squeeze entry points. Key points are when insiders buy shares, their shares are removed from the lending pool. This is part of the GME corporate bylaws, by the way. They believe that this is likely triggered squeeze 1.0, as that happened roughly 2 days after Cohen's 9 million shares were likely recalled when he got added to the board. Regulatory involvement, it's slightly less likely, but it's really unlikely the SEC is going to step up and enforce their own rules. But hey, if they did, we might see some reductions in fails to deliver and a blatant naked shorting happening with GME. However, even more unlikely is a share recall for vote. There's a number of reasons this could happen, but it's unlikely if this were to happen, non-naked shorts would need to cover. This is what we've been trying to call for a long time, trying to get them through their voicemail and trying to email their investor relations, and then people moving out of Robinhood to brokers that can stop lending their shares. After this, I moved a few shares out of Robinhood. I didn't realize they were being lent out to shorts, and Robinhood was pocketing the difference. So you can only get Robinhood to stop lending your shares if you move to a cash account. But interestingly, Robinhood's instructions on how to downgrade a cash account has disappeared from their site. So if you really want to stay on Robinhood, that's a way to go about it. Or if you want to move to a Webull, where you have a lot more flexibility on what you can do with your money and how you can prevent Robinhood from shorting and causing the situation again, go ahead and check out my link down below and use Webull to get 2 free stocks. I think it's just a good investment in your future because it's the same technical tool that I was showing in the beginning of this video. So how are we thinking about GME right now? This is going to sound extremely strange, but they have never been more excited to lose money. They are currently holding several thousand shares in GME, but their position is only 25% of their desired position, and they cannot wait to buy GME at lower prices. They hadn't bought any shares since $35, wow, and sold on the way up to take some profit. But they're slowly starting to add again around $50 with the profits they made from trimming on the way up. When it got above their price target, they shared in part 2 of $125. None of this squeeze drama, broker drama, etc. changes the fundamentals of the company and why they were bullish in the first place. They think that in the core short thesis of GME is another blockbuster destined for death is dumb, and we like the stock. They think that Cohen is going to cause a future re-rating of the company. Since part 2, some interesting developments have happened at GME, including the addition of new officers of the company, one Chewy exec and one ex-Amazon exec as a new CTO. They strongly believe that Cohen has a strong chance of becoming CEO, and they don't think that they would have been able to add the talent recently if it had not been for Cohen, and the creation of a tech officer position is a clear signal that they are thinking about how to run the company changing. Think about it. What a blockbuster with a website If it was just a blockbuster with a website, why would they need a CTO? Big plans are afoot. $4 billion for GME is cheap. That being said, they're hoping for a further dip. They're selling puts from 40 down to 10, hoping to score as many cheap shares as they can and try to take advantage of all the still insanely high IV. Final suggestions for if you guys are in the same boat. This is going to be a long flight. This is going to be a long fight. It is painful for all of us, regardless of your cost of entry, because longs would have won the battle had the market remained free. Instead, funds, clearinghouses, brokers colluded to restrict buying and eliminated the demand side of the market. Here's some thoughts on managing your GME positions going forward. Take advantage of IV while it is still high. While IV is still high, sell puts if you want to sell calls to reduce your cost basis. For example, they sold 226 9p for like 5 cents. That's a 6% return on capital in less than a month. And either they own GME at $9, awesome, or they keep the premium, also good. They personally believe that we will not be allowed to squeeze unless regulators step in and open the market here, which is not going to happen quickly, if ever. That's what the GME hearing was mainly trying to do. See if the market could be opened up and make sure that Robinhood can never do this again. Doesn't seem like that they chastised Robinhood CEO enough because he just didn't want to answer a yes or no question. They also sold some November 70p for $42. Let me explain the trade for those of you who don't sell puts normally. Selling puts gets a bad rap of pennies in front of a steamroller, but this is not the case with GME if you do it right. Someone paid him $4,200 now for a requirement that they would be forced to buy 100 shares of GME at $70 in November, right, $7,000. So they have to put aside $2,800 of his own capital to secure this put. In two scenarios, in this mind, this is a trade that can't go. I can't say that word. But there are also downside risks. Have your price target. Have your own price target, right? You couldn't keep riding the train up as much as that would cause the squeeze to happen. We all have a prisoner's dilemma that we have to keep in mind. Keep a valuation target in mind below which you believe it makes sense to add and above which it makes sense to trim. If you are in need of some research, see gmedd.com. And they also wrote a long-term bull targets in Endgame Part 2. Buy low, not high, folks. Don't FOMO. Stop sharing your positions publicly. I know this is anti-Wall Street bets, but I think sharing them is great for this community. But in the case of GME, it's an attack vector for you. This is why I very rarely share my actual portfolio. Be careful of holding weeklies until expiration. Remember the multiple trading halts. What if trading gets halted on Friday at 2 p.m. and doesn't resume for the rest of the day? All of your calls would expire worthless depending on your broker and your cash positions, maybe even your ITM ones. Roll or sell if you're taking profits, your weeklies well before expiration. Get out of Robinhood. Do it now. It is a raging fire. While Robinhood was just a pawn, in their opinion, why would you want to use a broker that could F you so easily? They lend your shares to shorts and they don't pay you for it, margin call you when you're winning, sell your shares at absolute lows, and pass all your data to Citadel. They don't think that free conventions is really free. Robinhood is worse for you, for your financial future. Go ahead and put your money into Webull instead. A lot of the same restrictions had happened, but when the GME restrictions happened, they did it later and they pulled the restrictions earlier. So that's one of the things that Webull has to offer, especially since they are not going to be the ones in the next part of the GME series that screws everyone over. Minimize regret, don't maximize profitability. They sold some shares early on the way up to take out their cost basis and some profit. They missed all the peaks, never sold any shares above 400, and holding out for maximum profit led to a bit more regret when things went the wrong way. Minimize regret. Make sure to sell pieces at a time up on the way. Don't bet more than they can afford to lose. They've been in GMEs long enough to know that just when you think going up is a sure thing, you can be surprised by a new trick. If you bet it all in weeklies all at once, you may not be able to recover from being wrong on the timing. Consider longer expiry or spreading out your purchases. They've held through multiple 50% plus drawdowns in the underlying. You need to be ready for the volatility. And then the last 3 points, watch out for stop loss hunts. It's a common practice for shorts to hunt for stop losses for cheap shares. If you've set up a stop loss, be really sure about it, and then don't sell in the dips. Buy the dips. You're only helping the shorts. If you need to sell to take profits, sell when it's heading up. Sell high, not low. It's simple math. All of you who are wondering whether you should sell GME at the very lowest point of yesterday's hearing, it's a simple question. Don't sell on the dips. Not financial advice, but this is investment sense. Save dry powder to buy on dips. Dips manufactured by shorts are buying opportunities. Take advantage of folks with paper hands to capture shares at low points. Gme has incredible daily volatility. Set a low limit buy and just wait for the order to fill. Have patience when buying. This is not financial advice. Do your own DD. Of course, they've been holding to what previously was valued at over $1 million in shares and calls, and they added 1,500 shares these last 2 weeks, as well as sold hundreds of puts to either capture 6 figures of premium or buy 7 figures worth of GME at price points I find attractive. And then finally, there are some really great questions about what Chairwoman Maxine Waters should have asked. I'm thinking about this is going to be a video by itself. If you guys like that content, go ahead and smash the like button because we like the stock. Do it for the GME ticker symbol down below. And as well as for me, I really appreciate a subscribe. For Meatball, look at him. Look at him. He's so cute. He is going to be so sad if you don't subscribe. And for now, but not for forever, peace.